Economic Reference in India. Summary. Slide ready notes. Chapter 4. Introduction. Economic reforms are policy changes introduced by the government to improve efficiency and competitiveness. In India, major reforms began in 1991 after a severe balance of payments crisis. These reforms aimed to shift India from a closed, controlled economy to an open, market-driven economy. Background of 1991 reforms. India faced high fiscal deficit, approximately 8% of GDP, low foreign exchange reserves, less than 2 weeks of imports, high inflation, 13%. To address this crisis, India adopted the LPG model: liberalization, privatization, globalization. Liberalization, removing government controls and regulations on industrial licensing, import, export restrictions. Foreign exchange, aimed to increase competition and productivity. Key measures: abolished industrial licensing, except a few sectors like defense. Reduction in import tariffs. Deregulation of interest rates. Privatization, transferring ownership or management of public enterprises to the private sector. Examples: disinvestment of PSUs like VSNL, Air India. Encouraged private participation in telecom, banking, insurance, etc. Improved efficiency and accountability. Globalization, integrating the Indian economy with the world economy. Steps taken: allowing foreign investment, FDI, FII. Promoting exports, joining WTO, 1995. Encouraging technology and global trade. Subsequent reforms, post-1991. Banking and financial sector reforms. Narasimham Committee recommendations. Reduction in CRR and SLR, autonomy to RBI. Entry of private and foreign banks. Tax reforms. Introduction of GST, 2017. Lower corporate tax rates. Subsequent reforms, post-1991. FDI policy. Automatic route for several sectors. FDI caps relaxed, insurance, retail, defense. Digital and structural reforms. Make in India, Digital India, Startup India. Insolvency and Bankruptcy Code, IBC, 2016. Benefits of reforms. Higher GDP growth rate. Increased foreign exchange reserves. Improved industrial and service sector performance. Expansion of middle class and consumer base. Challenges. Uneven growth among sectors. Rural and agricultural distress. Jobless growth concern. Rising inequality and dependence on global markets. Conclusion. Economic reforms transformed India into one of the world's fastest growing economies. Continuous reform is essential to maintain competitiveness and inclusive growth. Voiceover script. YT narration style. Welcome back to our JAIIB series. In today's video, we'll explore Chapter 4 Economic Reforms in India, one of the most crucial topics for your JAIIB exam. India's economic reforms began in 1991 when the country faced a severe financial crisis. With falling forex reserves and rising inflation, India had no choice but to open its economy to the world. These reforms are based on the LPG model: liberalization, privatization, and globalization. Voiceover script. YT narration style. Liberalization removed unnecessary controls and licenses, allowing industries to grow freely. Privatization invited private players to run businesses efficiently. And globalization connected India with world markets through trade and investment. Since then, India has seen banking reforms, GST implementation, digital revolutions, and policies like Make in India and Startup India, all strengthening the economy. Voiceover script. YT narration style. However, challenges like unemployment, inequality, and rural distress still remain. Economic reforms must continue to ensure inclusive and sustainable growth. Thanks for watching. Don't forget to like, share, and subscribe for more JAIIB learning videos. Easy level. The major economic reforms in India began in which year? A. 1985. B. 1991. C. 1995 D. 2000. Answer. B. 1991. 2. LPG model stands for A. Liberalization, privatization, globalization. B. Labor, productivity, growth. C. Legalization, protection, growth. D. Loan, policy, grant. Answer. A. Liberalization, privatization, globalization. 3. The 1991 reforms were introduced due to A. Fiscal surplus. B. Balance of payments crisis. C. Oil price increase. D. Political change. Answer. B. Balance of payments crisis. 4. Who was the finance minister during the 1991 reforms? A. P. Chidambaram. B. Dr. Manmohan Singh. C. Yashwant Sinha. D. Pranab Mukherjee. Answer. B. Dr. Manmohan Singh. 5. Privatization means A. Increasing public ownership. B. Transferring ownership to private sector. C. Creating new PSUs. D. Reducing competition. Answer. B. Transferring ownership to private sector. 6. Liberalization removes A. Subsidies. B. Price control. C. Government restrictions. D. Employment. Answer. C. Government restrictions. 7. Globalization integrates A. Domestic economy with the world. B. Villages with cities. C. States with the center. D. None of these. Answer. A. Domestic economy with the world. 8. India became a member of WTO in A. 1991. B. 1995. C. 1999. D. 2001. Answer. B. 1995. 9. Disinvestment means A. Buying new companies. B. Selling government share in PSUs. C. Merging private firms. D. Reducing FDI. Answer. B. Selling government share in PSUs. 10. GST was introduced in which year? A. 2016. B. 2017. C. 2018. D. 2019. Answer. B. 2017. 11. FDI refers to A. Foreign domestic investment. B. Foreign direct investment. C. Fiscal deficit indicator. D. Financial data index. Answer. B. Foreign direct investment. 12. Narasimham Committee was related to A. Banking sector reforms. B. Industrial policy. C. Rural development. D. Employment schemes. Answer. A. Banking sector reforms. 13. The LPG reforms were announced under A. New Industrial Policy 1985. B. New Economic Policy 1991. C. Financial Policy 1995. D. National Policy 2000. Answer. B. New Economic Policy 1991. 14. Which sector benefited most from liberalization? A. Agriculture. B. Manufacturing. C. Services. D. Construction. Answer. C. Services. 15. Make in India initiative focuses on A. Import promotion. B. Manufacturing in India. C. Agricultural exports. D. Tax exemptions. Answer. B. Manufacturing in India. 1. Which of the following is not a component of economic reforms? A. Liberalization. B. Privatization. C. Nationalization. D. Globalization. Answer. C. Nationalization. 2. Reduction in CRR and SLR was part of A. Monetary reforms. B. Fiscal reforms. C. Financial sector reforms. D. Structural reforms. Answer. C. Financial sector reforms. 3. Fiscal deficit during 1991 crisis was around A. 4% of GDP. B. 6% of GDP. C. 8% of GDP. D. 10% of GDP. Answer. C. 8% of GDP. 4. Disinvestment policy was first introduced in A. 1980-81, B. 1991-92, C. 1996-97, D. 2001. Answer: B. 1991-92. 5. Globalization leads to A. Trade barriers, B. Increased imports and exports, C. Reduced competition, D. Price controls. Answer: B. Increased imports and exports. 6. The tax reform that unified indirect taxes is A. VAT, B. Service tax, C. GST, D. Income tax. Answer: C. GST. 7. Insolvency and Bankruptcy Code, IBC, was implemented in A. 2015, B. 2016, C. 2017, D. 2018. Answer: B. 2016. 8. Which five-year plan is called the Era of Economic Reforms? A. Sixth Plan, B. Seventh Plan, C. Eighth Plan, D. Ninth Plan. Answer: C. Eighth Plan, 1992-97. 9. Structural reforms aim to A. Control inflation, B. Reduce imports, C. Improve long-term efficiency, D. Reduce employment. Answer: C. Improve long-term efficiency. 10. Privatization improves A. Efficiency and profitability, B. Bureaucracy, C. Monopoly of PSUs, D. Fiscal deficit. Answer: A. Efficiency and profitability. 11. The Industrial Policy 1991 introduced A. Licensing for all industries, B. Automatic approval for foreign investment, C. Increase in PSU monopoly, D. Trade restrictions. Answer: B. Automatic approval for foreign investment. 11. The Industrial Policy 1991 introduced A. Licensing for all industries, B. Automatic approval for foreign investment, C. Increase in PSU monopoly, D. Trade restrictions. Answer: B. Automatic approval for foreign investment. 13. FII stands for A. Foreign investment institution, B. Foreign industrial investment, C. Foreign institutional investor, D. Fiscal investment indicator. Answer: C. Foreign institutional investor. 14. Entry of private banks was recommended by A. Rangarajan Committee, B. Narasimham Committee, C. Kelkar Committee, D. Tarapur Committee. Answer: B. Narasimham Committee. 15. India's membership of WTO helped in A. Restricting exports, B. Enhancing global trade participation, C. Limiting FDI, D. Increasing subsidies. Answer: B. Enhancing global trade participation. 1. In 1991, India's foreign exchange reserves were sufficient for how many weeks of imports? A. 12 weeks, B. 4 weeks, C. Less than 2 weeks, D. 8 weeks. Answer: C. Less than 2 weeks. 2. The Disinvestment Commission was set up in A. 1993, B. 1996, C. 1998, D. 2000. Answer: B. 1996. 3. Who chaired the first Disinvestment Commission? A. Raghuram Rajan, B. G. V. Ramakrishna, C. Y. V. Reddy, D. Bimal Jalan. Answer: B. G. V. Ramakrishna. 4. Current account convertibility was introduced in A. 1992, B. 1993, C. 1994, D. 1995. Answer: C. 1994. 5. Full capital account convertibility was suggested by A. Kelkar Committee, B. Tarapur Committee, C. Rangarajan Committee, D. Narasimham Committee. Answer: B. Tarapur Committee. 6. The concept of NPAs in banks came after A. Narasimham Committee I, B. Narasimham Committee II, C. Kelkar Committee, D. Tarapur Committee. Answer: A. Narasimham Committee I.